Real estate investing doesn't mean you have to own property. There are ways to invest in real estate and receive cash flow without the hassle of being a landlord. How do I know? I'm May. I left corporate after 13 years by building boring, repeatable wealth, and I'm teaching you how to do the same. Make sure you stay to hear what all the options are. First is house hacking. House hacking is exactly how it sounds. The main goal with house hacking is to reduce your monthly mortgage or your rental payment by renting out parts of your home. This can be renting out a room, it could be renting out, let's say, your entire basement. It can also be buying a duplex and living in one unit and renting out the other. This is ideal for somebody who already owns their home or is able to sublet a rental. Second is REITs. These are companies that own, operate, or finance real estate across different sectors. Many REITs will hold a diverse range of real estate assets. You invest by purchasing shares on a stock exchange. It's kind of like buying stock in a company like Apple. One big benefit is that REITs distribute a very strong dividend yield. REITs are actually required to distribute 90% of their taxable income to shareholders. Third is long-term rentals. This is where we start getting into becoming a landlord. Long-term rentals are a great asset and they provide stable monthly income while the value of the home appreciates. You do need to make sure that you have enough cash reserves for any capital expenditures or CapEx that might occur. Fixing a roof, the water heater, HVAC, etc. A lot of these big ticket items will eventually need to be serviced and falls under the responsibility of the landlord. Most of the time, it's not worth it for you to hire a property manager for just one unit. It would make sense if you have multiple long-term rentals in the same city or area. You might actually get into a negative cash flow situation if you decide to engage with a property manager versus managing the property yourself. Fourth is short-term rentals. And these are what all of the gurus are pretty much touting on social media. Personally, I think they're overhyped. Yes, it can be a great investment and there are depreciation and tax benefits you can take with a short-term rental, but you have to put in the work. You need to actively participate in your short-term rental in order to take advantage of the STR loophole. This is not a passive investment. The other important caveat is that rental income, it's a lot more volatile. It is highly dependent on seasonality and the type of market you're in. So you need to be okay with unpredictable income. And don't forget, you need additional cash to furnish the home. Unlike long-term rentals where the renter actually brings their own furniture, STRs are already fully furnished. Having a budget for furnishings is crucial, especially as these items see more wear and tear. Fifth is syndication investments. A syndication is made up of general partners and limited partners. General partners typically find large-scale properties to purchase and they're actively involved in the investment, whereas the limited partners are completely passive and only supply capital. So they are not involved in the day-to-day. You, as a limited partner, do not have any voting rights or say in the day-to-day operations, but in exchange for the capital that you gave, you're able to get a portion of the equity and cash flow at the end of the investment term. Make sure you do your due diligence on who to invest with. Plus, you need to be okay with your investment being locked for a few years, as most of the terms are at least 2+ years. Enjoyed this video? Like and subscribe to my channel for more personal finance and real estate investing tips.